Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, April 19th, 2023. It's 11:22 a.m. Eastern Time. I'm starting the video, and I'm going to do an update on the equity markets and just a couple other, the core, really core holdings, at least I have, some of the things I've highlighted lately, and that's Treasury bonds, which I have just closed out and may reverse to a long position here, cover gold, silver, and the equity markets. So those three, I kind of consider those core. They're not, it's not all my holdings, but it's really what I've been focused on lately, and pretty much overweighting it. So I'm going to start out with ZB only because that's more timely right now. It's the most timely of all, because we just hit that my 129 support level right there. It says 129.009 to the button, and that's at least this point in time, I think there's a decent chance for a reversal. We could see more downside, but what you have here, this is the same chart I was sharing before, 6-month 2-hour candles. Remember, we had the case for that short was major resistance up there, coupled with the divergent high, so a short at resistance. But it was also, based on its own technicals, as any trade I ever take is. I'll never take a trade, even a hedge. But this was both a pure play short for that reason, and as I mentioned, a hedge to my equity shorts, with the logic being that if the market continued to go up, you would most likely see Treasury bonds going down for several reasons, but one of which being also a flight risk off trade. Treasuries are risk off. When the market's correcting, they usually go up, and when the market's rallying, institutions will sell those and move money over to equity. So it played out well, and right now, again, that's really good support, 129 right there. Numerous reactions along the way here, and you can see if I zoom in a little tighter, again, this is the 120-minute chart, but you could see something similar on a 60-minute if you stepped it down. That is a little bullish falling wedge there, complete with positive divergence. Needs to, of course, to confirm the divergence, PPO needs to cross over, and we also need to break out. So any rally, again, I'm kind of split. I think we probably take another leg down, but for me, like I said, removing this does two things. It further removes any that indirect hedge against the short positions, which I think, and I'll get to the equity market in a second. I think the equity market is just ripe for those next sell signals that I've been looking out for, and I'll get to that in 1 second. So that's it. Let's not talk anymore on it. Take it, don't take it. If you traded it, there's ZN, the 10-year. I just showed you ZB, the 30-year, but this is a hourly. So you can see you could do the same thing on ZB. And of course, guys, I'm sorry. This is typically what I'll trade, especially with Treasury bonds, because they're so the moves are so little. 1% move in a single day is actually a pretty big day for Treasury bonds. They usually move less than that. So therefore, to make it worth your while, you have to either take a lot of TLT, which is the ETF, or you could leverage up. There is a leverage ETF, but I'm not a big fan, especially if the timing, if I don't think there's going to be a strong unidirectional move. I talk about that a lot. That's when I'll use, or think that the leverage ETFs can actually outperform. But if you grind around to finally get to your target, then that's where the leverage works against you. Either way, you can see the bullish falling wedge pattern. So consider this also a long trade idea. And on ZN, the 10-year, you have that support levels right here at about 14.058. And we're just a hair below it. So if anything else, a recovery back above, or a breakout above the downtrend line, aka that 60-minute wedge, would mean that little that breakdown was a false breakdown, aka bear trap, and could send us up here. And that's all I'd be looking for right now if I'm gaming, just to bounce back to those previous support target levels, which support once broken becomes resistance. So again, that's ZN, and then here, let me step it down for you to a 60-minute on ZB. You typically get more bang for your buck trading ZB over ZN, because a 30-year bond, you have usually bigger moves because of the higher duration on those bonds. Duration is the percentage, or how much a bond will move in relative to a change in interest rates. So the higher duration, longer term bonds have the higher duration. So there it is. Nice little 60-minute wedge. All right, let's get off that. Again, TBT, or I'm sorry, TLT or IEF, which are the 30 and 10-year ETFs for the Treasury bonds. Just correlate the levels. You can replicate those charts there and do the same thing. Okay, next up, gold. Kind of doing this video in reverse order. I usually cover the equity markets first, but we'll get to that last. No change there. There was our most recent divergent high. 60-minute chart here. Nope, 2-hour candlestick, so 120-minute chart. 6 months price history, divergent high, breakdown, back test, zigzagging lower. Hit the first target there. Reverse a hair shy, but really close enough. You want to always cover a little bit below the actual support level when it's obvious to a lot of eyes. The buyers will often step in early, so that's effectively a hit of the first, second target. Typical reaction so far, and based on the charts, I still favor more downside. So if nothing else, when you're bearish or short something, if you think there's more downside, it's just like being a bull in reverse. You buy, instead of buying the dips, you sell the rips. Meaning, if you covered there and took profits, you could. We're in kind of a no man's land. We're smack between the next support, which is at 1995 first target, and then resistance there. So I can say this: if we bounce back all the way to 2023.50 or so, or a little shy of that, you always, same thing in reverse, just like when you want to cover your shorts a little before support to miss a reversal if the buyer step in early. If you're looking to short 2023.50, you might want to sell a little early. Same reason that the sellers will look to sell, sometimes step in early. Sometimes you make a perfect tag of resistance, and the same thing, stops, depending on your entry, you can set a tight stop, or maybe allow for a back test. Really nothing much more than a back test of that wedge. Right, so no change there. GLD is your ETF. And so this is again we had a lot going on here on the daily chart. You have negative divergence, which was confirmed recently with the bearish PPO crossover. So you had divergence on both the RSI and the PPO. You put in that island reversal top right there. That's that candle separated by gaps on both sides. And we've been moving lower since that island top right there. Gold's dropped so far about 3%. Nothing big, but again, I favor downside, and I'm still in that, short the rips like today, or the snapback rallies. Actually, gold's actually, well, it's bounced since where it was at the lows today, but it's still down 0.5%. And then silver, SLV is your silver ETF. Same thing here. Let me try to get these lines to load. There we go. There's your steep uptrend line, breakdown, sell signal that came on Friday. Followed through, hit that first target / support, 2276. A little bounce, maybe a little flagging action going on here. When you see what looks like a flag like that on the daily, step down to the 60. You could maybe draw a little cleaner trend line. Sort of. Well, you really had. That's more of a. That's a textbook flag right there. That on that initial drop, little flagging action, little kickback rally, but that's what it looks like on the 60-minute chart. Bottom line, it doesn't appear to me that the selling's over yet. So therefore, viewing snapback rallies as objective levels to add back on. And SI silver futures. This, of course, is the ETF for silver right there. Your futures are SI. And you had the divergent high recently right here. A negative divergence, a nice, clean, beautiful uptrend line in which to short. A very impulsive breakdown, sell signal. Hit my first target there, 25, or 25,252. Then that dropped as expected, went down, hit the second target, 24,880. Little bounce back, hit it again, bounced today, but we're right back to resistance where it's another objective short add-on. And there'll be a stop along the way somewhere in the midpoint, but I think we might get all the way down to this level here. My convictions aren't super high on that. All I can tell you is right now, if you took profit at that second target, well, you would have done it there. You could have done it again today, and we're back to resistance, and so you could make a case for another objective short entry or add-on there. And likewise, GDX continues to move lower since our sell signal. You had a rally into that $36, which was that T4 from all the way back here. Resistance hit that level. Then went on to break down and give us that sell signal there. Of course, around the time gold and silver broke down and continuing to move lower. It's down. You're going to get more bang for your buck, excuse me, trading the miners versus gold, because it tends to follow gold in the same direction, just moves up moves up and down at a higher percentage. So it's already down, which is typical, about twice what gold is. You're down 6.17 or a little over 6% from that recent high. And next target here, 33.10. Rough target, but pretty accurate, and also a very good level. I think you'll probably get a reaction there, unless you get some snowball type selling in gold and silver, and you could go on down through there. And as of now, I'm just kind of eyeing this. This is just really a pullback trade. I'm not looking for a major top in gold, but I'll give you my thoughts. Like I said, a couple weeks, about a month or 6 weeks ago, maybe so, I had a kind of a soft pivot. I've been adamantly longer term bullish gold, silver, and the metals and the miners. And then, like I said, based on my outlook for the euro and the stock market, kind of didn't mesh unless we see a decoupling there. And again, I will continue to update my thoughts. As of now, I think we see a little more downside in gold and silver, and I'm viewing this bounce back today. Again, I'm referring to the bounce back off the lows, which is in GDX. It's almost about exactly 1.61%. Viewing that as a objective add-on or new short entry. Again, I speak to because everybody has different entry points, and some people, a lot like me, most of my trades are scale into positions, scale out. There are some all-in, initial positions on a breakdown, but I tend to manage positions that way, where I lighten up at certain levels. If I'm in a swing trade, I call it micromanaging a position, adding to, sometimes reversing, even gaming bounces to or pullbacks, depending long or short, in swinging, what I call little micro trades within a larger swing or trend trade. Ignore these targets; they were set earlier. That's not the current targets on GDX. If anything, look for probably a first target there, about 33.36. And again, I'll continue to update this one. Let's move on to, before I said I would just cover these, including the equity markets. Let me just give you an update on natural gas, since I put an update on the homepage today. I still like it. We went under that level a little bit, and that's, natural gas is volatile. That's why you got to give it a little room. If you run this thing with a 1-2%, 3% stop or a trailing stop, don't even bother in either direction, long or short. It's just one of the most volatile commodities, and one of the most volatile securities out there that I trade. So so far so good. It dipped a little bit below there, but we're right about, for all intents and purposes, right on that 224-ish level right there. We're at about 240, and you can see, you got to zoom in a little bit. So that's it. Now, one way to look at it, we already punched through there, and that should have cleared out any stops, sucked in any short sellers. If that's what it is, going to be a little whipsaw. And so at this point now, since you've already reversed, you could set a stop right at or just below today's low, because that again, quote unquote, shouldn't be violated at this point, because we already punched through there. So ideally, this one continues on up to that next target there from here. Okay, now let's move on to the EKG, known as the chart of QQQ, because that's exactly what this looks like, an erratic EKG with an irregular heartbeat. This is a 5-minute chart. We're just going back. It's really the end of March here, and you can see it's just up, down, up, down, up, down, and go nowhere. So, and I read and hear all the comments, and I know there's a lot of differing opinions out there, but bottom line is the Qs have gone nowhere. If anything, they're down from where they were right around the beginning of the month here on April 4th. But again, would not start high-fiving if you're short or declare victory. It's a stalemate so far, or a Mexican standoff between bulls and bears. We'll see where it goes. That's just a 5-minute chart, but let me go to the 60 and show you this. We have we're still that was basically an equal high. Divergence comes when you have either a equal or higher high in price with lower lows in the indicators, which is what we have here. So we continue to diverge. It's still anybody's game. Let's not read too much into it. But I'm going to talk about that a little bit right now here in a second. So we still need to see about I have it on 312, 313, all the way down to about 312 on the daily chart. So 312 if you want to play it safe. Solid break below there should do the trick. And I'm going to just take a quick look at the daily chart. I'm going to flip boards here and go to board number, let's see, I have board number 2 right here. Okay, so first and foremost, we still have negative divergence. And again, this is clear negative divergence. There are no guarantees it'll play out. Sometimes divergences are burned through, but it is a big part of my trading. And the last time we had negative divergence on the all-important daily time frame was when the market topped. It was even more clear on the S&P 500. You had roughly equal highs on QQQ, and then, but what I wanted to point out is this trading range. So this is the trading range I've been talking about, and so like you can see here, since actually it was all the way back to March 31st is when we peaked, and we had roughly an equal high there, that one I just showed you on April 4th, right? And then roughly an equal high right here on April 18th, and there's the trading range. It's a box. So again, say what you want. We're all going to have our opinions, and some people are completely market agnostic, meaning they have no opinion. They're just going to wait, and that's the purest kind of trader that waits for a breakout and then just jumps on it. And there's always a risk that it's a whipsaw, and it's no big deal. If you take a long upside breakout and it proves to be a whipsaw, well, at the point which is pretty clear it failed, then you recognize you're wrong, and you could stop out. Same thing on a downside break. But so I am still expecting expecting and will add to shorts on a solid break down below the range. Pretty simple stuff. Because of the divergences and many other things, trend indicators and things that I'm using, I believe any upside is limited. So I just want to say that I'll give my shorts, which are just pretty much going sideways recently, a little room on an upside, because I think any upside breakout will fail based on, again, the divergences and some other things out there. But that doesn't mean I'm going to hold them, on a 10% rally on an upside break there. So let's just look at these boxes, these trading ranges. This one, I just duplicated the current trading range. What I wanted to show you is that these trading ranges, don't last forever. The market will not continue to go sideways in a range like this. It's going to break one way or another. And that B, from these sideways ranges usually comes a pretty good move, i.e. a tradable trend. And so again, respect which way it breaks. I'll give you my thoughts. I won't immediately respect an upside break, but I will begin to, at that point, start to, depending how much we follow through, start to layer. I like to layer out of swing and trend positions with staggered stops, like something like that. And I'll do it tactically, strategically. I'll read the charts. I'll look at volume. I'll look at the market leading stocks. I'll look at the S&P 500. I'll look at the equal weighted indexes. I look at a lot of things, and then decide, hey, is that breakout going to be the real deal? So I just want to show you here. Oh, well, first of all, let me show you, when you take the box, then this box measures, if you look at the distance of the box, so what's useful is this shows you time right here. That distance, or how wide the box is time. So let's just look at these other trading ranges. So this one was right about the same, and I highlighted this one back then, and this is the last time I went full out long. I had shorts leading down into that move, as I talked about back then, and at that point I started taking hedges because the fangs looked very bullish to me: Apple, Tesla, Amazon, and the likes. And then I told you, in here, that I covered all shorts and went pure long, expecting outperformance from those market leaders. And now the takeaway is, you can see that trading range was A, about the same time, and B, like I suspected and talked about at the time, it's, those ranges are like a coiled spring with the market building energy, and typically whichever way you break, as long as that breakout isn't just a quick whipsaw, that's usually the next tradable trend. So you had it there. There was a bigger range, a little more sloppy and loose, right? But you can see roughly, the top and the bottom, especially the bottom. That one had a downside break, right? And you had a pretty powerful thrust from the downside break of that range. We dropped in a matter of just over a week, less than 2 weeks, 6.25%. That's a swing trade all day long on the Qs. And so other than that, the market's usually going up or down. You can see. So I boxed in. Here's another box, little trading range right here, where the market, the buyers and the sellers kind of battled it out. And then who won? Well, there it is. The bears won. See the breakdown? And then from there, you dropped about 10.6%. So there's another range. Again, the takeaway is it was about the same period of time. This one was a little shorter in duration, and just almost about the same size top to bottom there. And you can see the bears won that one. You can also see we're in a bear market. I believe we're in a bear market with more downside to come, and you can see that almost all these ranges. And please, if you see any I missed, let me know. But I studied this pretty good, and it's a bit subjective. You can say, well, there's a range, but a little sloppier. This was the biggest one, the topping right here in QQQ and SPY. And you can see, so the market went up, started bouncing around in a pretty well-defined range, right? And had one little whipsaw to the top there. That was actually an intraday break. We closed the candle back on the top. Then we had a little whipsaw to the downside. They tried to buy it up and then couldn't hold it. And right after that, boom. And once it was clear to the masses that range had broken to the downside, once again, you had a very sharp, less than 2 week drop of about 11.8%. So that's what I wanted to show you. The two takeaways here is, A, this range is getting long in the tooth. There's no guarantee as to how long it can go, but typically the smaller the box, top to bottom, the shorter it lasts before you break out. This was a much larger. This was the end of a bull market right there in QQQ. And so you had a bigger trading range, and same thing we could do in SPY. If you look at SPY top, SPY was a little bit making higher highs, a little bit different from QQQ, but for the most part, kind of set up that range, broke to the downside, and and these ranges aren't as clear. QQQ has the clearest ranges, that's why I picked that one. But there's a little trading range in SPY. There was a trading range in SPY. This one again is making slightly higher highs, so I really don't box it the same way I'd box that QQQ range. And so that's it. So it all goes back to those levels I told you to watch on QQQ. That's SPY right there. I'll give you these levels today. Really probably the most important ones. If you want to set an alert, you want to minimize the chance of shorting or getting out of your longs. Again, if you share the same mindset as me as to where we're going, a break of 406 should really be the nail in the coffin, I think, for SPY, as long as, of course, we break down below that 3. Again, I call it 3 here on my 60-minute chart. I have 313.62, but on the daily I have 312. So like I said, you can see it there, and called 312.50 on the 60-minute chart, those last two candles, and the levels I gave you on NQ, and that should, I believe, do the trick. So that's that trading range right there. It's pretty well defined. So, and again, a break of it should be more, and if it's anything other than just a brief whipsaw down and back below, it should be a swing tradable position, or signal, where you're looking at high single digits to possibly double digit trend coming out of there. And then since this is a short video, I'll just go over the fangs. I had a sell signal today on one of my favorite individual, if you want to trade individual, Meta. Meta broke down this morning. Now, I didn't highlight it. I was going to get it out to you, but I didn't highlight it for two reasons. Number one, what I did instead, I got out the fact that the S&P 500 futures, they broke down. They're still on breakdown mode, so there's still a sell signal there. However, you know me, even though right now I'm not trading ES, I'm trading NQ and RTY to a small extent, but mainly NQ. That's my primary swing short position now. But what I was going to say, even if I were to be trading ES, you personally, I want to see NQ or the Nasdaq 100 breakdown. Otherwise, this breakdown in ES, which right now is textbook, it's a breakdown and a perfect back test. You could make a case, as I'm doing this video, to short ES right there. However, you're going to increase your odds substantially of this trade working and playing out and not proving to be a whipsaw, meaning we come back up, if the Nasdaq 100 also breaks down, and if the SPY, remember these are the futures, that's a clean trend line, pretty clean, but if you can look here, there was one violation, brief violation I had right there. So what you can do now is draw what I call a BOD, or benefit of the doubt trend line, and that comes in off the same lows. You capture that reaction low that I excluded there, and now you have that one there. And when you go to SPY, and again, I'm doing this because I always use that analogy of a, criminal defense trial. The prosecution has to prove beyond a reasonable doubt. So in other words, the way to look at this, we're in an uptrend, a near-term uptrend right now, since November, or early in the year in the stock market. And so, therefore, just like a defendant is innocent until proven guilty, when you're in an uptrend, you need some pretty strong evidence to start shorting. And so, like I said, the all-in moment will come when, let me go back to SPY. There's the level on SPY. Actually, on the daily, we took out my candle today. So there's another sell signal. But if I want to do a BOD, there's that little spike through there. Let me go down to the 60-minute chart. This is what I gave you on the 60 today. On SPY, when I got out to you, there's a reaction low, there's the low, second, two more candles there, a couple there, and so that's my BOD, or benefit of the doubt trend line. This was my minor trend line. It shifted a little this morning because I drew in pre-market, so that one broke down, and that's exactly the same one you see on the futures, but yet on the SPY ETF, which a lot of traders use in their analysis, this is the secondary benefit of the doubt trend line. And look at that, you have 411.75, really good level there. Let me color that up because I think that's an important level as well. And why is that? Because you had a major reaction high there, a couple right there, another reaction, rejection, then we broke out, back tested it here, and we're above it. So if we break 411.75, you're also going to break the trend line, and that's going to be a pretty powerful sell signal and the next checkbox for the bearish case. So again, I can't make a strong case to be aggressively short right now, but you'll bump that case up if and when that level goes, and then especially if and when 406 goes. So there's all the levels. Yeah, it's a lot. And again, it's like I always say, these sell signals to me on the equity markets, they're incremental, not all or none. It's not a binary all or none. Okay, if SPY breaks that, we're going down. No, it's just going to increase the odds if and as each of these levels are taken out. Okay, hopefully that makes sense. And let me just wrap it up, showing you a couple of the market leading stocks. You do not have to know where the 500 stocks in the S&P are going. You don't have to know where the 100 and the Nasdaq 100 are going. You only have to know where the top half dozen, because that makes up, top 5 or 6 make up over half of the returns. Here it is right here. 51%, over half of them come from, of the returns of the Nasdaq 100 come from Microsoft, Apple, Amazon, Alphabet, Meta, and Tesla. So let's just look at those and we'll wrap this video up. Divergent high on the daily, everything already covered there on QQQ. Apple, a negative divergence. If and when my lines populate, I'm running the new beta version of TC2000. I don't know if that's what's slowing things down today. There it is. Here's your primary bear market downtrend line. That's the all-time high in Apple right there. End of the bull market, start of the new bear market by just about every metric. And that's it. So been rejected every time we've been to that trend line. We'll see if it happens again. No guarantees. Obviously bullish if we take it out, but again, an incremental thing. This market, if anything, it's full of trickery. from the the algos, whatever you want to call it. And so break above that trend line is not a be all end all, because you still have the previous major reaction high right there. That starts to really chip away. So I will say, look, here's the way it works in my head. Bulls take this out with conviction, especially a solid daily close above the downtrend line. Yeah, they get a check mark, and that chips away a little bit at the bearish case. So you definitely don't want to add to shorts at that point. You could certainly, if you're bullish, add to longs if you want, unless it holds. I'm talking a break out of the trend line there. But and then the next big check mark they would get would be a break above this previous reaction high right here. That's certainly a big check box, right, for the bulls. As would, especially to see this divergence get negated with higher highs on the PPO and MACD. Those are the check marks the bulls get, and their minus marks, or whatever you want to call it, or check marks against the bearish case. However, break above the trend line is not going to really do too much. It would be what I just acknowledged in itself a bullish event, but you still have a big wedge forming here, a big bearish rising wedge. The divergence is at this point in time not even close to being negated or taken out. So Apple could go up another 3-4% easily and still have these negative divergences intact, and then it would just set the stage for an even more powerful bearish event if and when we reverse, because that trendline breakout, this would be cheered by the bulls and undoubtedly clear out some more shorts, suck in some more longs. So then if that happens, then you want to see a failure, and a failure would coincide with a fall back below the trend line. I know I'm making a mess here. Fall back below the primary uptrend line off the highs, as well as a breakdown below the bearish rising wedge. That to me would be kind of one of those. When I say all-in sell signals, please know I would never put all my money short one stock, especially like Apple, but it would be a pretty aggressive short moment. Again, if everything else aligned. Apple is one stock. It is the largest, or right now technically, recently the second largest when I checked the other day. And for some reason, Microsoft, even though the market cap is smaller at 2.21 billion, Apple's 2.61 trillion. I'm sorry. Yeah, they had Microsoft at a higher weighting. Again, about the same, roughly, so almost 13%. In that one, boom, at resistance, broke the steep uptrend line, and like everything else, it's moving sideways. It's waiting for the rest of the fangs to break down. Maybe they don't, but you still have the divergence. So nothing's changed in the last few weeks. We have negative divergence. The only thing that's changed, we've had a few trigger sell signals. I'm going to get to Meta in 1 second. Meta trigger a sell signal today, but again, it's a sell signal that I'm treating with skepticism, because the S&P 500, we have too many of the indexes on various time frames still above some key support levels. So that increases the odds that the breakdown of Meta today may prove to be a whipsaw. So what I want to see for Microsoft is a break below 283 right there. That would also be the break below the recent trading range, that box right there. These are the things I'm looking for. And obviously, things I don't want to see, again, incremental, not all or none, is a break above the about 292 level, which is the top of that range. So, right, bullish, right, bearish. Okay, simple stuff. Alphabet, trendline break, moving lower. Also a big level back here. Me and these boxes. I talked about this one back here. That was a trading range. Alphabet broke down, very clear. A blind man can see that trading range right there, right? That's very obvious. And then you had a breakdown. You got a big move down. I'll tell you how much it dropped. The stock fell from that point down to lows over 10%. Rallied back, made a perfect back test of it, and got rejected hard. On that second rejection at 105, the stock then dropped into the November lows, almost 21%. So that to me is a big level. It popped it here, but there's an example that skullduggery, trickery, whatever you want to call it in the markets. They popped it there, popped it again, proved to be a failed breakout, failed after that if they couldn't hold it, and the stock fell after the breakout failed under 105. It fell another 15%. All I can tell you, yeah, there's been a few pops, but no more now, since you already had these other two pops right here. see the way this works to me, that was still, it is a big level. But when you have not just one but two reactions and a third, that then becomes the resistance level. So that's the resistance that Alphabet failed at. It's now dropped back below the 105 key 105 level, and we're coming up on a lot. So keep an eye on this one, guys. You're coming up on the primary bear market downtrend line, number one. That's a biggie, right? That comes in off the all-time highs there. You had a second lower reaction there, reaction, and this is all right now a breakout. So again, we all see what we want to see. I try to recognize both sides of it. In other words, bull bear. Bulls see a breakout and what may be a back test coming up, and that's where, if you are bullish on this market, you want to buy with both fists on the back test. And it's easy because you can set a stop somewhat below if it fails. So I'm not saying that facetiously. It's not what I'm going to be doing, but if I had that outlook and I thought the bear market was over, or at least we had a lot more upside to go, this is where I'd be buying. Now, if it fails, it's going to be ugly technically. You're going to fail the 200 exponential simple, which, by the way, that's what capped all these rallies. There's a 200-day exponential there. You took out the 200s here. You kind of cut through them a little bit, but then clearly gave them up right there. And bear markets, there's another rejection at the 200s. And so if we fail back below there, solid move back down below, you're going to have fallen back below the downtrend line right there, back below the 200s. Your last chance, in my opinion, is this uptrend line off the lows. And they'll probably step in and buy that, but if and when that goes, we're probably going to get that next leg down in the bear market. So, hey, this may never happen. Let's one thing at a time, one day at a time. Let's watch these levels. Watch the 200s, watch the downtrend line. Let me extend that out a little further. And so those are the things I'm watching. Amazon, a little island top right here. So far it's below that. That's one thing you want to see. The bears want to see you stay below there. Amazon's a good example. I'll turn back off the line, turn all the lines off again. Here's a good example of a stock that behaves well, if you will, to the 200-day moving averages, reacts off those. It was support, as it usually is in a bear market. Again, I have the blue and red lines. They're the 200-day exponential and the 200-day simple. And you broke them right here. Clear breakdown. You had a double-digit drop. Rallied, rejected off the 200 exponential. Rallied again, rejected off the 200 simple. Rallied, rejected off them both here. Another attempt, rejected off the exponential. Rejected off the intersecting simple and exponential 200s right there with that island candlestick, island topping stick, and we're still below them right now. So this one's in a, again, you can play glass half full, glass half empty. You could say we are at a near-term uptrend, or what has the makings to be a near-term uptrend off the January lows in Amazon. But really all we've done is we've effectively just put in one higher low, and we have not even put in two higher highs. So really, technically, that's not even an uptrend in Amazon. It's still clearly, by every other metric, in a downtrend with a clear series of lower lows and lower highs so far. So again, you take out this previous reaction high, you will also have taken out the 200-day moving averages, and that's going to be hard to argue as anything but bullish, right? However, if we get rejected anywhere from now or before that previous reaction high, and especially if we start taking out these previous lows, it's just going to increase the case that I've been making that this has just been a bear market rally and we're about to embark on the next leg down. Sell in May and go away, folks. That's the old adage. Anyways, let's look at a couple more. Let me turn on the trend lines. There's also a downtrend line that Amazon's at from right here. Busy chart, but you have a trend line right there. It includes that reaction high, several there, another one there, one more right there, and where we're at right now. So there's Amazon at resistance. If it pops it, you get the 200 days right above it. And like I said, you take out those 200 days, it's, that's near-term bullish as long as it holds. And a couple more and we'll wrap it up. NVIDIA, it's same thing. A lot of these semis, they stopped going up That's a short trade on the site. I'm personally short the semis. I think there's a big drop to come. And I make a lot of sayings up over the years, and one of those is, in life they say patience is a virtue, and I agree with that. But when I add on to that and say, if patience is a virtue in life, it is an absolute must in trading. So, so far, been a little early on shorting the semis and the Qs, but patience pays. That's where I think they're going to go. And if they don't, look, there's big resistance there on the video. And again, I'll look at the semis collectively, not just one, but this is the biggest one. Also one of the top components of the Nasdaq 100. That's why I'm watching it. You want to keep it very simple. We already broke down below the rising wedge, the uptrend line, but you have, just like QQQ, because tech and semis are a part of tech, are in a sideways trading range. Need to see that. Bears need to see that. Bulls need to see that, right? Simple stuff. Tesla mentioned recently was one of my favorite shorts. Based on this, we had the 60-minute bearish rising wedge breakdown, daily chart. You had a lot to look at there. You rally right into the 200-day simple exponential moving average, just like you did there. Failed. It's been moving lower, and probably has a lot more downside. And then Meta, this is one of my favorites right now. Meta has broken down today, so you can see this is when I started talking about. I had an alert this morning. You have the uptrend line, big negative divergence. That's a steep, large, very large bearish rising wedge. Not only that, you also have your primary bear market downtrend line just above it, right there. You have some price resistance as well. Gotta love it. And just steep negative divergence. I'm looking for at least a double-digit drop in Meta. And again, it is a sell signal in that. So here's one way to do this too. The odds of this breakdown playing out right now aren't super. They're high. They're favorable. Well over 50%. Let me just say that, so I'm not waffling around. I would recommend shorting this. I'm just trading the NQs. I might take it. I have an account I trade individual stocks too, and sometimes my primary account I like futures. So I may take an individual position. But where I'm going with this is, one thing you can do if you don't want to short the market, because we're in a sideways trading range in QQQ, and that could continue. Pick the most bearish. I've always said this. You give me any sector or any index, and almost at any point in time, if I make the effort personally, I want to show you, you can outperform that sector. Whether first of all, I need to be bearish. If I think a sector is going to go down and I'm bearish, then I pick the most bearish looking components within the sector, maybe a half dozen or so, short those instead of the sector ETF or the index, in this case the Nasdaq 100, and you will most likely outperform. And likewise, when I'm bullish, like gold mining stocks, for example, I can buy GDX, or I can buy the half dozen or the dozen miners that look the most bullish to me, and in most cases outperform. It takes more work, more effort, but I wanted to say that. So maybe you want to start nibbling on some short exposure, or you want to be hedged right now. You're not sure where things are going. You want to short the most bearish stocks in the Nasdaq 100. Well, Meta's one of them. As of today, we have a sell signal, and you can be long some of the more bullish ones. That's a way to diversify and even partially hedge. Or let's say, one more example, you're bullish and long QQQ. You've been one of the folks on the homepage saying just buy the dips, don't fight it, everyone else is doing it. Okay, but you do have your concerns. So you're long QQQ. Here's a way to do an indirect hedge. Yes, Meta is one of the top components, but I've seen cases where some of those top components actually go down. It's not going to drop 20% with the Nasdaq 100 going up 10. That is extremely unlikely, but it can outperform to the downside or underperform the index. So it is profitable to either make a pure play a short profit on there, or be long QQQ and then short enough Meta to help offset it. So if the Qs keep going up, again, if you're long, if you're long QQQ, but then the Qs start to reverse, this Meta short should drop more than QQQ, and then help offset your losses on QQQ because you're short there. So again, it's So I call it an indirect hedge because you're not buying put options on QQQ. That would be a direct hedge to a long position on the Qs. So either way, sell signal, and that sell signal will the way I would look at this, guys, if you're only looking at just Meta, I would not take a full short position in it right now. I'd take a starter, add to it if and when we get those next sell signals I talked about earlier on the Qs, the Nasdaq 100, and the S&P 500. It's that simple. At that point, if Meta is still below the trend line, then you could increase that to maybe a second or a third lot, or you do a third, a third, a third. When I say a fractional position, everyone's different. You could do a half and a half. You could do a third, 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 a quarter, quarter, quarter. It all depends on how much you want to put in there and how much time you have to devote to this whole thing. Okay, I should wrap it here. I've covered a few more things than I told you I would, but what I'm seeing is I'm seeing that slow roll from a strong risk on market, meaning tech, stocks up first and foremost, but even the high flyers, tech, and then crypto and everything else. And I'm seeing we have, I give you this one as an official trade the other day. I've talked about it for weeks and months, saying if and when the market takes next leg down, cryptos will most likely outperform because they tend to go up more than stocks when the stock market's rising, and they tend to fall more than the stock market when the stock market's falling. And so what I do see, this one, Bitcoin broke down. We're still above my first target, not by a lot, but try to move that T1 down to where it should be. And Ethereum too. They're finally starting to show, and you can't. It's no high-fiving yet. We haven't even hit the first target, but at least you're seeing the momentum wane. And again, this is what my trading is all about. I look at, put a big emphasis on these momentum indicators, and again, it's how we see things. I know bulls right now, and I've heard it a lot on the homepage. The market just won't go down for anything. It's just strong bid. It's going up. Well, I see things different. I saw a market that was going up strong that is no longer going up. Again, I'm talking about the sideways range in the Nasdaq and everything else. So I see a market that stopped going up. Now, it could be consolidation before the next leg, but that's also quite often how these turning points are coming in, and that's why I look at these momentum indicators, and they confirm momentum was strong, but you're seeing the PPO start to roll over. In fact, it's turned down now, showing you that momentum has waned, and that's usually you get a high level PPO rolls over. See how it was going up, up, up here, up, 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 and it started going down there right when Ethereum topped last time. It was going up, had a little jog down, but it never really, the slope turned about flat, had it continued up, and then it rolled over right here. And that's where Ethereum rolled over and topped. There was a high level turn down, and there's the crossover. That's the next thing. First you turn down, then you get the bearish crossover, and that's usually the nail in the coffin. And so when you get the bearish crossover this time, you're going to have negative divergence. You didn't even have negative divergence those other two times. And after we topped, that one was a drop of about 48%, and this one was a drop. I can't grab the lines directly. I have to turn it off. Turn them off. That one was a drop of 59%. So I don't know why I'd expect anything much less than that this time around. High double digits. Could easily drop 40-50% or more, especially with the fact that we have now divergence as well. Okie doke. All right, so I ended up covering a little bit more than I said I would, but those are the things I'm watching and personally trading now, and that's where I think they're going, and no change in my outlook. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.